it's Eric with Jazz Wealth Managers. Let's talk about a little bit of financial planning today. Thing about it is that there's some misconceptions with financial planning. Some advisors use one planning way of doing everything that they do. Other advisors use another method. The problem is I think that there's so many different methods that are out there, and not one is always the right answer for you. So that's kind of what I want to talk about on this. I want to sit here and go through it with you and actually show you exactly what I'm talking about. And one of the first methods I want to look at is cash flow, because this is one type of retirement planning. A lot of people are probably doing it. You may be watching and doing this yourself right this second. The way you do that is you can run it just on an Excel spreadsheet. So just to give you an idea real quick on what this looks like, let me see here. If we go over to the handy dandy board, and I can find the right buttons to get us there. So what I want to talk about is with cash flow, a lot of things are looking at it from a rule of 72 perspective. The thing about that is honestly, when you're looking at cash flow, it's looking at everything in a linear fashion. So to give you this exact breakdown on how this works, so let's just say the rule 72, the way that works, to give you a little bonus here with everything I'm talking about with planning, is that if you took your return, so let's just say the 7.2, so you've got 72 divided by 7.2, that's 10 years. So what this means is every 10 years, your money would double if you were to get a 7.2% return. So how exactly does that play into cash flow planning? Well, everything happens in a linear fashion, or everything happens one after the other. So every year you would get that 7.2% return. That's the kind of thing that cash flow is looking at. It's not looking at it as though, the real markets would get you one year, you might get a negative 14% return. The next year, you're going to get a 23% return. It's not looking at it like that. So instead, it's looking at it from that linear fashion. So that's just showing you exactly how this is actually calculated out. So let me actually go here now and show you the screen. And that's what I want to show you with this cash flow analysis and doing cash flow planning. So right here, if you're looking, you've got $100,000 in income. What ends up happening is we have inflation built in. So with inflation being built in, it's going to go up 3% a year. Well, 3% a year is 103,000, then 106.90, because again, you've added 3, now you've got the little bit more. So kind of getting a little crazy with it and dumbing it down a bit. So I apologize if you're sitting here watching, you're sitting there saying, well, okay, I get the basics. But the idea here is what's going to happen is that your growth also, so if you're looking at your accounts, they're going to grow in a linear fashion. Now, when you start to withdraw the money, it is going to come out in a linear fashion as well. And it all sounds good, but what happens when the market does take adjustments? That's what doesn't get accounted for whatsoever when it comes to cash flow planning. Now, some advisors like it because honestly, if I go down here and I show you your accounts, let's just say at the end of the plan, with cash flow planning 2049, this person at 87 years old passes away, their total assets, $747,529. Now, it looks really good, but what if we run this in another way, in another type of planning, and that's what I want to show you here. So let's go ahead and look at this in one of the other types of planning, and that's using a Monte Carlo analysis. Now, we talk a lot about a Monte Carlo. It depends on which softwares you're using, what you're looking at, but in general, you're running 1,000 scenarios. Those 1,000 scenarios are going to show you the best stock market here, the worst stock market, and it's going to run 1,000 scenarios in between to really try to find you a median line. That's taking into consideration just what I had talked about. Maybe one year you're getting a negative 14% return, one year you're getting a 23% return. So if we're looking at that, as I said, you've got the 747,529 here. In the same type of planning scenario, but using a different method, this is projecting you only have 318,000. So that just shows you that the Monte Carlo is clearly a bit more conservative on the approach, taking into consideration ups and downs of the market. Now, with the Monte Carlo, you're looking here and you've got what looks to be, if you live in Florida, a hurricane trajectory path. But the idea is it is taking those ups and downs into consideration, looking at different approaches there. The problem with the Monte Carlo that I've found is sometimes it could make it so that you're actually being too conservative in retirement. So everything has a little bit of an issue. I mean, there's not a one size fits all. That's why we like to look at the Monte Carlo, but we also do like to talk about the cash flow. To be honest with you, the cash flow side of things, jumping back over here, this is a great one when you're not in retirement. Let's say you're watching this and you're 25 years old and you're, not retiring till 65. Well, it's a great way to just give you a rough approach because you're not really worried about the ups and downs of the market through the next 30, 40 years before you retire. Instead, what you're going to look at is what are the averages, because that's what you want to focus on, making sure you're getting a consistent average long term. When you're retired, a little different because, you're starting to withdraw the money. So you want to look at this Monte Carlo and really try to figure things out. Now, one of the big things with the Monte Carlo, though, is what's nice is we can actually stress test this. This is a good thing when it comes to your retirement portfolio, especially in retirement. I actually had somebody call just the other day, and they were a bit concerned. They said, hey, the market's going down. I'm planning on retiring within the next year, and my 401k has just plummeted. Am I okay? What is going on? What if the market continues to go down? What did I do? I took her and we jumped into Nest Egg and we really started to look at that. And what we looked at was the stress test on the Monte Carlo and the idea here of looking at, okay, we're going to take where you are right this second. What happens if right now or in the next day, the markets drop another 20%? Well, if the markets drop another 20%, is this person going to be okay? They have an 89.9% probability of success still, which is very good when it comes to the planning side. Social Security, that's going to be their risk because what happens if Social Security is reduced by 20%? In this plan, this could definitely cause an issue for that person. So we want to look at all these things. These are things that you could try to run in a cash flow, but it's kind of difficult when it comes to what you're looking at there because, again, it all happens in a linear fashion. So those are a couple different approaches that people are looking at when it comes to retirement planning. The problem is that there is not a one size fits all. Your scenario is unique, and that's why we like to look at a couple different styles there. Thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.